The United States 10-year Treasury Bond has just had its worst first half of the year performance in 234 years. That's since 1788 when George Washington was president of the United States. That's right, everybody. Not a joke. The United States 10-year Treasury, just to say it again, has had its worst performance for the first half of the year since George Washington was president. So you can't say that Biden's not breaking any records, doing anything unprecedented here, because he just shot to the top of that list. Ready? Let's dive in. So it looks like the bond market might finally be breaking. And if you've followed my channel for any length of time here, you know that I've said consistently for years that bonds are the worst thing to invest in. Why is that? Well, let's take a look at how a bond works. A bond is debt. All it is a loan. I give you $100, you owe me $101 back, right? And so anytime there's debt, you're going to ask for a little bit of a payment on top of what you loaned, because then that compensates you for the risk of potentially not getting paid back. In the case of United States treasuries, in the case of United States corporate bonds, high yield bonds, especially junk bonds, when you look at the debt markets in the United States and around the world, quite frankly, for the last 10 years or so, interest rates have been so low that it is preposterous to think anybody would look at that and say, that's a good risk to reward ratio, because you're giving somebody $100 with the best case scenario, you get $101 back, $102, $103 back. And the worst case scenario is default, where you get nothing back. And you might say, okay, well, a high guarantee of getting 2% is worth it because it's basically, it's as close to risk-free as possible when you're loaning to the United States government. Not so fast, because when you factor in inflation, this year you have $100, you can go buy $100 worth of stuff with that. If you loan it out and get it back in a year and you get $102 back, but prices have gone up, so that thing that used to cost $100 is now $104 because there was 4% inflation, you just lost 2%. And so when there's any rate of inflation whatsoever beyond the interest rate that you're getting on your loans, that means you have a negative return for your best case scenario. That means for US government bonds for years now, but especially now, your best case scenario is to lose 2, 3, 4, 5, 6% on the conservative side. If you believe the official inflation numbers, you lose up to 6% for your best case scenario. That's the reward. And the risk is outright default, right? Where you don't get anything back and you lose everything you put in. So I've been saying for years that bonds, especially US government bonds, are probably the worst investment available. Now, I will admit, and anybody again who's watched for a while, there have been specific time periods where I've named treasuries as a potentially good short-term trade. Never as a long-term investment, but potentially good short-term trade in order to ride the wave of interest rates moving up and down, investors piling in, piling out, because prices will move up and down, even though the trend of interest rates has been moving up. And so I have said, hey, now might be a good time to make a short-term trade here, but never as a long-term investment. And what we are seeing right now during the first half of this year, US 10-year treasuries have had their worst first half since 1788. That's 234 years when George Washington was president. So you might be asking, okay, well, why? And the first answer is everybody's realizing what I've been talking about for 2 years. And it hasn't just been me. People way smarter than me have been talking about this for longer than I've been talking about this. But people and institutions and investors are starting to catch on. Return free risk just doesn't make sense. Why would you do something where your best case scenario is you're going to lose money to inflation? And so it's not just the United States either. If we take a look at this picture here that was tweeted, is from B of A Global Research. I'm sorry, I don't know how to pronounce his name. I follow him on Twitter. He posts good stuff like this. You can see here that it's not just a United States thing. This is an around the world thing. Government bonds around the world are on the course for the worst year since 1865, Civil War era right there. And so world government bonds everywhere are having a really bad year right now. Again, because people are selling them. Prices are going down, rates are going up. And so we see this massive line here in 2022 for this first half here, worse than during the Marshall Plan, worse than World War II, worse than the UK coming off the gold standard, worse than post-World War I. Absolutely devastating returns for bonds, government bonds around the world. And to further highlight what's going on here, take a look at this picture tweeted by Daniel LaCalle. We can see that liquidity is moving in the wrong direction here. So we can see that on this blue line, U.S. Treasury bond futures, this is the 13-week perpetual contract, moving down, and the U.S. government securities liquidity index is moving this way. And so we are seeing very stressed liquidity conditions here. Again, more and more money is moving out, partly because the main people who have been buyers of government bonds this whole time has been central banks, the guys who can print money to buy this government debt. And they've been backing out of the market saying, we're not going to buy as much anymore. And now, like the Fed, some of them are actually selling them. So liquidity is drying up in bond markets, making them more volatile, making interest rates go up, and making the performance the worst that it's been in 100, 200, sometimes even more years. Absolutely devastating year for bonds, proving right many of the people who have been saying don't invest in bonds for a long time now. Now, the final thing that I'm going to show you guys here that I talk about quite a bit is the reverse repo facility. This is cash that is sitting in this facility at the Federal Reserve. So banks need collateral. They've got cash. They give the cash to the Federal Reserve in this reverse repo facility. They get collateral in exchange to meet the collateral requirements that they have to have as a bank. And that cash, in return for that, they're getting an interest rate paid on that cash. So this is risk-free. This doesn't have a price. They're not buying anything here. So this is risk-free for the banks and institutions that are giving this cash to the Fed. And so they're getting paid this interest rate, which is just above the federal funds rate, risk-free. So they don't have to go out into the market and buy bonds that everybody is selling. They don't have to buy short-term government debt because they can get an interest rate here that's, because it's risk-free, that's pretty good just by sitting at the Fed, and don't have to worry about price fluctuations in the debt and liquidity concerns of having to sell if everybody wants to sell at the same time. And this is the Fed's secret weapon that I keep on talking about. As soon as we get up to a point in the bond markets where they break and their bonds go no bid and things just start breaking and go crazy, there's no liquidity, some financial institution says, hey, we're bankrupt, we're insolvent, we need an injection of cash. When something crazy like that happens, the reverse repo facility at the Federal Reserve, that interest rate is going to zero or close to it, because suddenly then that $2 trillion worth of cash, over $2 trillion is in there right now, will flood out, because the money started flooding in there as soon as they started paying an interest rate that was higher than the federal funds rate to soak up all the excess cash in the system. So as soon as the Federal Reserve needs to, they'll lower that interest rate on the reverse repo market. That $2 trillion will flood back out into the bond markets, providing liquidity, pushing interest rates down. It will give them a $2 trillion runway, which might last only a couple of months. We'll see, but it'll give them some runway where the Fed can continue to raise interest rates. They can continue to sell assets off their balance sheet and continue to say, hey, look, we're fighting inflation. Look what we're doing. In the meantime, out of their back pocket, they're shoving $2 trillion of secret weapons, secret liquidity back out into the system. So the bond markets are starting to break. Liquidity is drying up, as we can see with this chart. The bond performance around the world is the worst in over 150 years. And in the United States, the 10-year Treasury has had its worst first half of the year since the start of the nation when George Washington was president in 1788, 234 years ago. But it has not quite fully broken yet. And we will know that things have gotten really bad once the money starts draining quickly out of the reverse repo facility and the Fed starts injecting that final cash reserve, that final secret weapon back out into the market to give themselves one last little bit of runway before they have to fully pivot. We'll see what happens. As always, really appreciate you guys. Thank you so much for watching. Have a great day.